Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Recently, some of you have asked me to look at UK companies, some of the UK companies that I own in my portfolio and so on, and you've asked me if I can do some analysis on these companies, and that's what we're going to do today. Unfortunately, UK companies are, in terms of finding information, they are quite difficult to find information on, because all the companies that I use or the websites that I use are basically focused more on the US side of things. But I do use Simply Wall Street, and that's the company that I use today to extract a lot of information from. So if you like this type of content and you appreciate the amount of time it takes, I'll be honest with you, it took me probably, I could have planned for 2-3 videos, just the time I actually spent on doing this research for these 5 companies. So there are 5 companies, some which I own, some which I don't. I'm going to share it with you. I'm going to explain to you what these companies are, what they just give you a brief description of what they do, as well as the fundamentals. Again, if you're interested in any of these companies, please don't take my word for it. Go and do your own research, because I'm definitely not a financial advisor. I'm some random guy who's trying to help the Muslim communities out there. And if you basically enjoying this type of content, please give the videos a like. It really helps the channel. Okay, so let's get started. So as usual, we are looking at the ticker, the company, the market cap, the moat, price, dividend yield, 5-year growth rate, payout ratio, dividend streak, safety, profit margin, free cash flow, total return in the last 10 years. Okay, we're looking at the forecasted annual earnings growth. This is slightly different, so 1 to 3 years. So how much the earnings are expected to grow. Again, this is, remember, they forecasted, it is not really this estimation. Okay, Simply Wall Street evaluations and then fair value. That's what we're doing. Right, so let's have a look at the first company. No surprise, the first company is a company that I own in my portfolio, and that's Unilever. Unilever sells almost all sorts of products. Okay, they've got market cap of $102 billion. They have a wide economic moat. Price is right now £40. Okay, dividend yield 3.5, which is very, very high if you think about it, right? And that's one of the reasons I'm actually I do like this company, because the dividend is quite high, but the payout ratios are quite low and so on. 5-year growth rate, we're looking about 6%, payout ratio 64%, which is very nice. Dividend streak, we're looking about 10 years of increase in that dividend, according to Simply Wall Street. Dividend streaks of 10 years, safety 75%. Safety comes from Dividend Safety website, Safe Dividend website. Free cash flow right now comes from Simply Wall Street, and that is 7.39 billion euros. And total return in the last 10 years comes from Morningstar, and that is 5.88% in the last 10 years. Forecasted about 9% growth in the next 1 to 3 years, which is very nice for this company. And Simply Wall Street valuation right now says is about 11% undervalued, so their price target is 45. Right now my price, I think, is about £40.80 or something like that, so not bad. If you can go up to that level, I'll probably be making some good money on that company. But it's one of those companies I want to keep in my portfolio. I'm not touching it. I'm adding to it every single week. As you know, I think I'm now on 70 something shares. I'm going to try to get to 100 shares. Next company is Rio Tinto. This is the company that basically does all sorts of mining things, iron ore and so on. Market cap of almost £90 billion. Okay, and then when we look at the, by the way, that was in dollars and pounds as well. Okay, it doesn't have economic moat, because these companies tend to be, obviously they don't have any competitive advantage. Price right now £53, dividend yield of 10.73%. That's the highest I've ever seen, I'll be honest with you. And one of the reasons I own this company is, obviously it's UK based company. If iron ore prices go up, this company goes up. If they go down, it goes down. But is the dividend yield. They recently cut that dividend as well, but right now it's almost 11%. 5-year growth rate of 36%. That's absolutely ridiculous. And payout ratio is quite low, 67% for a company that has a 10% dividend yield. 5 years of increase in that dividend. Safety about 40%, according to Simply Safe Dividend. And for that reason, you might think, okay, this is very dangerous, but I know this company will cut their dividend at some point because they already have. And I know that for that reason, I'm still in it, okay? But I know they will cut some point. Even if they cut it to 5%, I still want to own this company because price appreciation is actually quite good in this company as well as the dividend. Profit margin, we're looking about 29%. When free cash flow, we're looking about $14.9 billion. This comes from Morningstar, is actually in billions because actually it comes from Simply Wall Street, but they actually show you in dollars instead of pounds. Total return in the last 10 years, we're looking about almost 9%, forecasted minus 14%, so decline. So earnings are expected to decline in basically the next few years. Maybe the price of the demand for iron ore might come down, but I don't believe that because China reopening now, and if the Chinese economy goes back to where it was, say, prior to 2020, I think this company will be booming because a lot of their basically a lot of the products is actually sold in China. So I don't know, we'll see what happens, but right now I own it, I will keep it, and that's the plan for now. 38% overvalued according to Simply Wall Street, and 39, almost 39 pounds is what they say in the price should be. As you can see right now is 53 pounds. Okay, the next company is another company that I own, that's Reckitt Benckiser. That is RB, is one of those companies that I've recently started buying, but I've been buying heavily lately. So I'll show you how many stocks that I own. $41 billion market cap. It has a wide economic moat. Price is right now 58 pounds. Dividend yield of 3%, absolutely beautiful. 5-year growth rate of 3%, not bad. Payout ratio very low, 42%. Dividend streak of 10 years. Safety, it says, according to Simply Wall Street, it says well covered by cash flows, which is absolutely fine. Profit margin, we're looking about almost to 23%. Free cash flow, 2.99 billion pounds. Okay, total return of 4% in the last 10 years, and forecasted to grow, earnings to grow basically about 3%. Right now, according to Simply Wall Street, is 34% undervalued right now. 88 pounds is where it should be. I hope it goes up there because that will mean that will be really good for me because I do own quite a bit of shares, and I will be buying in the next few weeks as we go along. The next company that I want to show you today is Seagrove. This company is a real estate company. Right now, they have a market cap of $10 billion. They have no economic moat. They have a price right now £8.36, and then dividend yield almost to 3%. 5-year growth rate of 8%. Payout ratio 82. But remember, when we look at the payout ratio, we look at the price to free cash flow ratios for this company is actually this is a REIT, so less than 90% is basically what we're looking for. Okay, and 11 years of increasing that dividend, it's according to Wall Street is well covered by cash flows. And for some reason Yahoo Finance thinks profit margin for this company is 646. I'm not sure how true that is. So if you're interested, just please double check. And free cash flow right now, we're looking about 324 million. That covers the dividend, which is absolutely fine. And in terms of growth, the last 10 years, you're looking about 9%. Forecasted 1.3% in terms of growth in next 1 year to 3 years. And right now, 4% overvalued. Their price is about £8 and basically less than 4 pence. So basically not bad, not far from where it is right now. The final company I want to talk about today is AstraZeneca. I'm sure you know this company is, I think it's the biggest company in the FTSE 100. $169 billion market cap. It has a wide economic moat, and I'm sure you know what the company is. A pharmaceutical company. All the COVID situations, I'm sure you have heard. £109 per share right now. Dividend yield of 1.92. 5-year growth rate 0. Payout ratio 42, which is quite nice and low. 1 year of increasing that dividend. And in terms of safeties, 70% according to Simply Safe Dividend, and profit margin 4.5. And in terms of free cash flow, we're looking at about $6 billion and 13% or almost a 14% total return over the last 10 years. In terms of forecast, we're looking at about 26%. and that's probably why this company are very bullish. Okay, so the forecast comes from Simply Wall Street, and they think the 26% growth in the next year to 3 years, and 38% undervalued at the moment. Their price target is $177 per share. If that happens, that will be absolutely amazing. I don't own this company. I considered. I used to own it early days. I think early 2000s, 2020, and when they were making the COVID vaccine. But what happened at the time was it was going up and down. It was very volatile, so I just kind of got out of it. I think it was at the time was like $60-70 pounds per share. But right now, as you can see, I definitely made a mistake for selling it. But yeah, there you have it. 5 different companies in the UK. Like I said, it's majority of this information comes from Simply Wall Street. Some comes from obviously simply what's it called, Morningstar. Finally, I'm going to show you in terms of Sharia compliance side of things. Unilever, as you can see, 99.72. In terms of interest bearing, they are quite high. Okay, 20 is my cut. It's 24. So I'm watching that, see how that goes in next quarter. If it comes back down, if the market cap obviously goes up, and obviously this will also decrease. But yeah, nothing too alarming in any of these companies right now. As you can see, Rio Tinto only 16%, 21% for RB, 24 Segro, and 15% for AstraZeneca. So yeah, there you have it. 5 Sharia compliant companies in the FTSE 100, probably one of the biggest ones as well in that whatever it's called market. So yeah, there you go. There's 5 different companies. What I will be doing is I'm going to look at more companies in that in the FTSE 100 in the next few months, inshallah, and then I'll share that with you guys as well, because I do think I kind of neglected the UK FTSE 100. There's a lot of companies in there that are Sharia compliant, but some of them are very, very small, and their growth is it hasn't been great in the last 5-10 years, whatever. The ones that I picked is the ones that I genuinely felt like, in terms of price appreciation, in terms of dividends, is actually I can make good returns in the next 5 to 10 years. So that's the reason why I own this company, just to be transparent as well. I want to show you some of these companies I've talked about and in my portfolio. So the first one being RB. So right now, as you can see, I'm 5% down. I own 30.2 shares of this company. I will be buying more in the next few months. And then Rio Tinto up about 8.5% right now, 25 shares. That's how much I own. Next one is Segro, 70 shares. Okay, and then Unilever, 72 shares. I don't have AstraZeneca in my portfolio because I do have quite a bit of pharmaceutical companies. I don't think I will be adding to my portfolio anytime soon. Maybe if it comes back down, I might be interested. But right now, the way things are, although according to if that growth is actually true, then that is absolutely massive. Okay, if it can go up $177 per share, okay, that will be really good. But right now, I don't own it. I don't plan to own it, and we'll see how it goes in the next few months. And basically, I'll keep an eye on it, but I'm not gonna add to my portfolio anytime soon. Anyway, I hope you enjoyed the video. I hope you enjoyed the transparency and everything else I'm doing here. I would love you to just give it a like, the videos. That's all I ask. I don't want you to buy any courses, nothing from me at all. Just to give the videos a like. Have a wonderful day. Assalamu Alaikum.